Good morning, everyone. I'm Ted Abernathy. I'm back again with you to give you an update on the Missouri economy. Since we gave our last quarterly update, I don't think we could have ever found a time where the economy changed more than it has over the last 3 months. I'm going to share a screen with you and do a few slides. And we came into February of this year with the national economy slowing slightly, but with due to the trade risk of the trade war with China, but still strong. Record expansion, a strong economy, full employment, record low employment, high consumer confidence. Savings rate was good. A healthy housing and commercial market in Missouri, low interest rates, and Missouri was on the rise, improving the state's business climate. We were at the end of the longest in our history, 113-month growth in employment, and then March and April saw real losses, dramatic. In fact, I love showing charts to y'all, and as you can see, this chart isn't actually right. The axis is wrong. If you drew this based on what really happened, the crash is historic, and these were more jobs than it lost at any time in our history. That gain in May came back. We had a bounce back of 2.5 million jobs. That would also be the largest single month growth in history. So there is some optimism as we look forward. Missouri's annual job rate through 2019 had ticked up in 19, was closing the gap with the U.S. rate. Missouri has lagged behind the rate of job growth in the U.S. Since the recession. And the state, though, in April lost 328,000 jobs. The state data for May will come out in a couple of weeks, and we'll make sure we update everything on that. Every state in the country lost jobs. Missouri actually lost fewer jobs than the average state in America, and half the loss of some of the biggest states. So the impact was about the way the economy works in your state, and there's a good chance that that could see some real bounce back. If you look at the Midwest, the neighboring states around you, you're in the middle of the pack. Kentucky had the highest losses, Nebraska the lowest in your area. The losses were across the board, but as you can see, the biggest single area was leisure and hospitality, where both the nation and Missouri lost heavily, almost half their jobs. When you open back up more of the area, you can expect many of those jobs to come back to you. The lowest areas of losses were in the financial services sector. In some areas in the country, some states, they actually didn't lose any, but in Missouri, just 2%. So you expect some of those white-collar jobs to bounce back pretty quickly. What can we expect going forward? Well, the real question for everyone is how many of the job losses are permanent versus temporary? As we've started opening back up in May and June, you're seeing a lot of people go back to work, but some of the losses will be permanent. There's a guess that somewhere around 10%. We're looking at contraction of the gross domestic product nationally and in every state of 4 to 6% this year. You're going to have significant small business losses, again, somewhere in the 10 to 20% of small businesses. And then the other key factor is going to be when consumers have confidence to go back out again. What drives the state economy is really a key to how quick the bounce back will be. If you're a tourism economy or an energy economy, it might be a little bit longer, but if you're a manufacturing, professional services, agricultural economy, technology like you have, chances are the bounce back is going to be pretty quick. We know that there'll be a few changes that happen. People and companies might consider where to move again. There are different factors that impact that. For companies, it's business climate, availability of labor, infrastructure, and cost. And so Missouri is well placed in many of those areas and could be the recipient of the recovery. There's an opportunity there that could take place. We should also expect a lot more robots around us in the future. We've had them in construction and manufacturing, but a lot of service robots will be hitting the marketplace. They're immune to COVID-19 and not subject to stay-at-home orders. And so a lot of companies are figuring out ways to bring robots in more into their labor force. Remote everything has gained ground during this period. Remote work, medicine, delivery of everything to your home, home entertainment. those are going to be lasting trends, and we'll see how they play out in the marketplace. They've created tens of thousands of jobs in some sectors and obviously hurt jobs in other sectors. It took us about 10 years to go from 5% e-commerce to 15%. We've added more to e-commerce in the last 8 weeks than we had over that last decade. How much of it sticks will be consumer choices, but some of it certainly will. And then we'll have some real estate adjustments. Office markets will look different. Some people will work from home, but also there'll be social distancing inside office. Brick and mortar retail, we've been hurt by the e-commerce. You'll see some vacancies there. But there'll also be supply chains that tighten down, that come back to the U.S., get somewhat more redundant. So you'll see a surge in warehouse and distribution space. And housing choices is going to be consumer choice. Packed, tight housing in dense urban areas probably will lose a little bit of its luster, but you'll see more spread out. That might bring some new cities into the growth opportunities. We can also expect that there's going to be some sort of a geo-muddle that takes place. Hong Kong right now is a tinderbox for future China-U.S. relationships. And before this all started, we were discussing Brexit and the South China Sea and North Korea and Iranian aggression in the Straits of Hormuz. As we come out of this, we can expect that there will be changes in globalization. They're certainly going to drop some. They reset after the Great Recession, and the trajectory dropped a lot. And what happens the next few months will also have a lot to do with how fast globalization rebounds, if it rebounds at all at this point. So finally, how long before we get back? It took 6 years for us to gain all the jobs back that we lost in the Great Recession. This employment drop is much steeper than that. And when we look, I think that many of the jobs will bounce back very quickly, but not all. And so you're going to have something that looks a lot like a Nike swoosh as a, not a W, not a V. W could happen if there's a second round of the coronavirus, but what we're going to see is some jobs lost permanently. We're also going to lose some people out of the labor force. I believe there'll be people that stay at home for homeschooling, for daycare, for elderly parent care, just to keep them out of high-risk areas. And so it's going to take us a while to get the labor force back, but it'll also take us a while to get the jobs back. We're still bullish on Missouri continuing the 2030 work. We think that there's opportunities that are taking place that Missouri could be a strong contender for. And so getting our eyes out on the horizon as we move from the crisis stage to the recovery stage is going to be a key for doing better. Thanks a lot. I'll come back to you in another quarter and try to update you. I hope that this quarter is a lot less dramatic than the last one has been, and good luck with all your businesses.